Today we're going to talk about earnings per share, or EPS. This is a very commonly used figure in evaluating company performance, both on a quarterly basis and an annual basis. So we have to know first how to report earnings per share. And GAAP requires that we report earnings per share on the income statement for both income from continuing operations, that's if we have a discontinued operation, as well as net income. So you actually show earnings per share on the face of the income statement. And we have two earnings per share calculations. We have basic earnings per share and we have diluted earnings per share. And it depends on the capital structure. So a company either has a simple capital structure or they have a complex capital structure. A simple capital structure means they have no potential common shares, what we used to call dilutive securities. Okay? And so if they have a simple capital structure, we simply show basic earnings per share. If they have a complex capital structure, that means they have one or more potential common shares or dilutive securities. So we have to show both basic and diluted earnings per share. So what are these potential common shares, you ask? These are shares that can be converted into common stock. And if you think about the equation for earnings per share, net income minus the preferred stock dividend divided by, I'm going to abbreviate, weighted average common shares. Okay? So here's our earnings per share, and a dilutive security is going to add shares to the denominator. And if you think about it, if the numerator doesn't change, but the denominator now has more shares, earnings per share is going to go down. It's going to be diluted. Okay? And so the reason we show earnings per share in diluted form is to show people the worst possible scenario, okay, of what could happen to earnings per share if all of these dilutive securities were to convert to common stock. It doesn't mean they're going to. It just means what if they did. So notice we have four potential common shares or dilutive securities: convertible bonds, convertible preferred stock, stock options, and contingent shares. So we're going to take a look at these and see the impact on earnings per share. So first, here is basic earnings per share, as we just saw a moment ago. And notice, if we have preferred stock, if the preferred stock is cumulative, then it doesn't matter whether or not we've declared a dividend, we have to subtract the preferred stock dividend from net income. If the preferred stock is not cumulative, then the dividend for preferred stock must be declared, or else we don't have to subtract it from the numerator of net income. Okay, so how do we calculate weighted average shares? This gets a little complicated, and I have to make the following comment. GAAP, or the FASB, the whole reason we have all these rules for earnings per share is to try to improve comparability between earnings per share and consistency in how we calculate the numbers. Now, you cannot compare earnings per share between different companies because they all have different shares outstanding. Okay, but for the same company, we want to make sure that we're consistently following the same set of rules. And so to enhance consistency and comparability, we make several assumptions. And as we get to those assumptions, I will point them out. Okay, so first, how do we calculate weighted average shares? We have to take into account the shares that are outstanding at the beginning of the period. If we issued any shares during the period we'll assume is a year in this case. Did we buy back any Treasury stock? Were there any stock dividends or stock splits? And were there any conversions to common shares for preferred stock or for bonds? So notice we follow a couple of rules. Stock dividends and stock splits are treated as if they happened at the beginning of the period. This is an assumption we make. Now, the difference between a stock dividend and a stock split and if we issue shares during the year is that when we issue shares during the year, we're raising capital, and that capital is going to be used for company purposes. So if we issue shares in April or May, we have 7 or 8 months use of that money. So the weighted average shares factor in the fact that we didn't have a full year's use of that money. We only had 8 months use, so we're going to multiply the number of shares issued times 8 over 12 months. A stock dividend or stock split doesn't raise any capital. So we simply double the shares or issue 10% stock dividend. We simply assume the dividend, stock dividend or stock split happened at the very beginning of the period. So we'll see how this works momentarily. And if any conversions of preferred stock or bonds take place, we assume the conversion took place at the beginning of the period. And if we are reporting comparative financial statements for 2 or 3 years, the beginning of the period is the earliest period that is being presented. Very important that you make note of that. Okay, so we have 50,000 shares of common stock issued and outstanding on January 1st. On March 1st, we issued 30,000 additional shares. On July 1st, we bought back 20,000 common shares, Treasury stock. And on November 1st, we had a 2-for-1 stock split. So first, we're going to assume the stock split took place on January 1st. So that's going to double the number of shares in each of the transactions. So notice, January 1st, we now have 100,000 shares. And since those shares were outstanding for the entire period, we multiply them times 12 over 12. Those are the months. And we have 100,000 shares. March 1st, we issued 30,000 shares. We've doubled those shares because of the stock split. So we multiply 60,000 times 10 over 12. Okay? We didn't issue those shares until March 1st. They weren't outstanding for January and February. So that leaves the 10 remaining months. So we use 10 over 12 as the multiplier. And that gives us weighted average shares of 50,000. And then on July 1st, we bought back 20,000 common shares. Again, because of the stock split, we double those shares. And we multiply that times 6 over 12. Since they were outstanding for the first 6 months, they were not outstanding for the last 6 months. So we multiply by 6 over 12, and then we bought back 20,000 shares, but the weighted average shares is also 20,000 shares, and we're going to subtract those shares. So the weighted average shares outstanding is 100,000 plus 50,000 minus 20,000 gives you 130,000 weighted average shares, and those will be the shares we use in the denominator to calculate earnings per share. Assuming our net income is 800,000, our weighted average shares, as we just calculated, is 130,000. And we're going to assume that we have preferred stock. Okay, 20,000 shares, $50 par value. They pay a 7% dividend. So the dividend is always based on par value. So the preferred dividend is $50 times 7% is a $3.50 dividend per share times the 20,000 shares would be a $70,000 dividend. Our basic earnings per share is 800,000 minus 70, that's the numerator, divided by 130,000 weighted average shares for basic earnings per share of $5.62. So that's basic earnings per share. Next, we're going to look at diluted earnings per share. Okay, so as previously mentioned, we're trying to show the stockholders the worst possible scenario. And that is if all the potential common shares were to exercise and become common stock, that would add the highest number of shares to the denominator, resulting in the highest level of dilution or reducing earnings per share. So to illustrate this, we're going to use the following information. First, our net income will be $15 million. We'll assume weighted average common shares of 500,000. And we have the following potential common shares. Stock options. We have employee stock options that were granted at the end of 2015. The employees cannot exercise them until after 2018, so the vesting period is 3 years. And they can acquire 40,000 shares at an exercise price of $20 per share. Our preferred stock is now convertible preferred stock, 20,000 shares, same $50 par value, same 7% dividend, and those are convertible into 30,000 common shares. And then we have convertible bonds of $5 million, that's the face value. We're going to pay 6% interest, and they're convertible into 50,000 common shares, and we'll need to know what our income tax rate is, so we're going to assume an income tax rate of 40%. Now, you should have a calculator and paper and pencil in front of you, and feel free to hit pause, rewind, anytime you feel that you're not grasping the material. Okay, so feel free to do that at any time, but let's move on. Okay, so the effect of stock options on diluted earnings per share, and we're going to exclude the convertible preferred stock and the convertible bonds. We're just isolating the effect of stock options on diluted earnings per share. So there's the same data. Now, here's one of those assumptions I was making reference to earlier. There's no doubt that if you took 20 different companies and they all had stock options exercised, they do 20 different things with the money that received. However, FASB says we're going to assume what they call the Treasury stock method. We're going to assume that the money that the company receives from the exercise of those options is going to be used to buy back our own common shares in the open market at an average market price. So let's see how this works out. Okay, so they exercise 40,000 common shares at an exercise price of $20 per share. That's $800,000. That's how much cash the company receives from the employees for exercising those shares. Now, if the market price is higher than the exercise price, and we assume it is here, then the employees instantly make money, and that's taxable, as we talked about in a different video. If the market price is below the exercise price, the term is they're underwater, no one's going to exercise those options. Why would you do that when you can buy them on the market for a cheaper price? So they're going to simply expire. They didn't have any value. Okay, so in this case, they exercised the shares, 40,000 shares at $20 each. The company raised $800,000. We're going to use that money to buy back common shares on the open market at an average market price of $40 per share. Okay, $800,000 cash divided by $40 market price per share would buy back 20,000 shares. So, what's the net increase to the denominator? Well, we issued 40,000 shares. We bought back 20,000 shares. So the net increase to the denominator is 20,000 shares. Okay, so in this example, we only have the stock options. So our basic earnings per share is 15 million net income. There's no convertible stock yet. There will be in a moment. Divided by the 500,000 weighted average shares, basic earnings per share is $30 per share. Diluted earnings per share is going to be the 15 million numerator, and we're going to add 20,000 net shares because of the stock options and then buying back the treasury stock. So our denominator will be 520,000 shares, and notice the diluted earnings per share is less than basic earnings per share. It has been diluted. If for some strange reason diluted earnings per share were higher than basic earnings per share, that would be called anti-dilutive, and we would ignore that dilutive security since it ended up raising earnings per share higher than basic. And again, we're trying to show them the worst case scenario with diluted earnings per share. Okay, so we're going to hang on to the stock options, and now we're going to add convertible preferred stock. Okay, so same data. Okay, and again, the convertible preferred stock is assumed to have been converted at the beginning of the year. If we actually converted preferred stock, say on July 1st, then we would have to multiply those shares times 6/12. But if they weren't converted, then we're going to, again, for the sake of diluted earnings per share, we're going to assume the conversion took place on January 1st. Same net income, same weighted average shares. Same stock options, we're going to add 20,000 net shares to the denominator because of the stock options. We're not going to go through that calculation again. Now the convertible preferred stock, this should look familiar, 20,000 shares, $50 par value, 7% dividend. That would be a $70,000 preferred stock dividend, and those are convertible into 30,000 common shares. So if the preferred stock is converted, then we would not pay the preferred dividend of 70,000. So we wouldn't subtract the 70,000 from the numerator. And we would add 30,000 common shares to the denominator. Okay? So basic earnings per share would be 15 million minus the 70,000, again, because the preferred stock was not converted. So we subtract this 70,000 dividend from the numerator, and the weighted average shares is 500,000. Basic earnings per share in this example is $29.86. Quick comment, I know the basic earnings per share is different than the previous example because in the previous example, we didn't have the preferred shares. Okay, it was $30 in the previous example. This is $29.86. The diluted earnings per share, since the preferred stock is assumed converted, we don't pay that preferred dividend, so we have 15 million in the numerator. We have 500,000 weighted average shares. We add to that the 20,000 stock option shares and the 30,000 convertible preferred stock shares. And that gives us 550,000 shares in the denominator. And our diluted earnings per share is $27.27, which we can see is lower than basic earnings per share. And it was also lower than the previous diluted earnings per share. We have to compare those to make sure there's no anti-dilution. That's actually what they call it. Okay, to this, we're now going to add convertible bonds. Now, bonds are a little trickier, so I have a separate example here to illustrate the concept before we go back to our other example. In this example, we're going to look at the effect of interest from the bonds on the income statement and taxable income. Okay, so we assume in this example, and again, this is a different example, that the face value of bonds are $300 million. No discount or premium here. I'll mention that briefly at the end. 10-year maturity, not that that matters. They're going to pay 10% interest. And these bonds, convertible bonds, can be converted into 10 million common shares. Okay? So the interest expense would be 300 million face value times the interest rate 10%. It would be, interest expense would be $30 million. Look at the two columns, the income statement with the bonds and without the bonds. We're going to start with operating income. Sales, cost of goods sold, operating expenses, they're all the same regardless, so we don't really need to even see them. So notice operating income, we start with is 200 million. If we have the bonds, we have to pay 30 million in interest. That's deductible, that's an expense. Our taxable income is 170 million. Notice we're in a 40% tax bracket. So 170 times 0.4, we pay 68 million in tax. Net income is 102 million. If we didn't have the bonds because they converted to common shares, then notice taxable income would be 200 million. 40% of 200 is 80 million in tax. Net income would be $120 million. Notice the difference between net income. It's 18 million. Okay, look at the bottom. It says, notice the difference. The difference in net income is our 30 million of interest expense, right? Our income without the bonds, if they were converted, would be 30 million higher. 30 million times 0.4, we'd have to pay 12 million in tax. 30 million minus the tax of 12, net increase in net income is 18 million. And that's the number we would add to the numerator for diluted earnings per share, and then we would add the 10 million common shares for diluted earnings per share. Okay, so hit pause. Make sure you're comfortable with that before we move on. In our example, back to our example now, same data, net income 15 million, weighted average shares 500,000, same stock options, same convertible preferred stock, And now our convertible bonds, and we issued them at face value, so there's no discount or premium, $5 million face value. Okay, we're going to pay 6% interest, and they can be converted into 50,000 common shares. So our interest expense, $5 million times 6% would be $300,000. Again, if we're in a 40% tax bracket, $300,000 of interest expense, again, if the bonds were converted, we wouldn't have that interest expense. That would increase taxable income. 40% of the $300,000 is $120,000. We would subtract that from the $300,000, and the net increase in net income would be $180,000. Okay? So the $180,000 gets added to the numerator, and the 50,000 shares that were converted, right, gets added to the denominator. So basic earnings per share is the same as it was in the previous example, $29.86. Diluted earnings per share, the numerator, 15 million net income. Again, we do not subtract the preferred dividends since those were converted. And we add the $180,000 of increase because of the related interest expense that wasn't incurred, right? So that increases net income by $180,000, and that's our numerator. Our denominator, the original 500,000 weighted shares, plus the 20,000 stock option shares, plus the 30,000 preferred stock option shares, plus the 50,000 convertible bond shares. Okay, that gives us 600,000 shares in the denominator. And notice diluted earnings per share, $25.30, is the lowest one. So all three of our potential common shares, the options, the preferred stock, and the bonds, all were dilutive. Okay? And again, a couple of comments. Remember, we assumed the bonds were converted into common shares at the beginning of the earliest period that we're reporting. Quick comment on if bonds are issued at a discount or a premium. Okay, as you may recall, the premium amortization or the discount amortization has an impact on interest expense. You're going to use the interest expense number when converting, just like we did in our example. It would simply be a different number than the $300,000. If there was a discount, the interest expense would be higher. If there was a premium, the interest expense would be lower, but you'd still go through the same exact calculation. Now, there's one more thing that unfortunately complicates the issue a little bit. And we call this the order of entry. Now, as we said earlier, there were 4 potential common shares: stock options, convertible preferred stock, convertible bonds, and contingent shares. The good news here is this only relates to the convertible preferred stock and bonds. And the reason for that is that when you convert preferred stock and bonds, there's an impact to both the numerator and the denominator. With stock options, and as we'll see at the end with contingent shares, they only add shares to the denominator, so they're not included in this analysis. So with the order of entry says which one should we calculate first, the preferred stock or the bonds, when trying to figure out what is the most dilutive or diluted earnings per share. Okay, so what we have to do is calculate what we call the incremental earnings per share. We look at the effect of earnings per share based solely on the conversion of preferred stock, and then we look at the effect on earnings per share solely on the basis of the convertible bonds. Okay? Again, we'll assume a 40% tax rate, but notice what we're going to do is we're going to change the bonds from a $5 million face value to a $50 million face value. That'll be a pretty significant impact, which we need to illustrate the dilutive effect, or the anti-dilutive effect, excuse me. Okay, same data. This should all look familiar, except for the bonds. Face value is now $50 million, 6% interest, still convertible into 50,000 common shares. Okay, so the incremental effect on earnings per share of both securities, preferred stock, if converted, we would have $70,000 more income in the numerator, and we would add 30,000 shares to the denominator. So 70,000 divided by 30,000, the incremental earnings per share for the convertible preferred stock is $2.33. which, by the way, is less than the basic earnings per share of $29.86, I believe. The convertible bonds, because we changed the number from 5 to 50 million, is going to be a significant difference. Okay, so 50 million times 6%, right, is what, $3 million. Okay, that would be interest expense avoided by conversion. So we would add that to taxable income. 3 million, we have to pay 40% tax. 30 million times 0.4 is 1.2 million. Subtract from 3 million, the 1.2 million, the net increase to net income is 1.8 million. Okay, that would be in the numerator. And then we'd add the 50,000 shares in the denominator. So the incremental earnings per share for the bonds is 1.8 million increase divided by 50,000 additional shares, $36 earnings per share, which is higher than my basic earnings per share, which is your main clue as to whether or not a convertible security is anti-dilutive. If the incremental earnings per share is higher than basic earnings per share, it is anti-dilutive, and that means you exclude that security from your diluted earnings per share calculation. So in our example, if we included the convertible bonds, we converted them to common shares, our diluted earnings per share, you can see the numerator 15 million plus the 1.8 million, the 600,000 total common shares in the denominator, diluted earnings per share would be $28 even. If we look at the diluted earnings per share with only the stock options and the preferred stock, it's $27.27. So the convertible shares, the bond shares, had an anti-dilutive effect because they improved the diluted earnings per share. And again, our goal here is to show the stockholders what's the worst case scenario. If everything got converted, what's the most diluted earnings per share number out there? And so because the bonds ended up being anti-dilutive, we would not include them in our diluted earnings per share calculation. So look at the note at the bottom of the slide here. As a general rule, whichever security has lower incremental earnings per share, you calculate diluted earnings per share with that security first. Okay? If the incremental earnings per share is greater than basic earnings per share, you know for a fact it's anti-dilutive, you're going to exclude it. There is a chance, though, it's slight, you don't see it often, but there's a chance that both securities could have incremental earnings per share that's below basic, but in the proper combination could still have a mildly anti-dilutive effect. So you still have to calculate the order of entry. And again, you always start with the lower number first. In our case, preferred stock was incremental earnings per share was $2.33. That's lower than the bonds incremental earnings per share of 36. So you build in preferred stock first, see what diluted earnings per share is, and then you factor in the bonds, compare that diluted earnings per share to the previous one. And whichever one's lower is the one you report. The last item, and the good news is we finish on an easy note, contingent shares. These are shares that will be issued if the company achieves a certain performance level. Perhaps it was a merger of two companies and they want to see if the subsidiary is performing properly, or if a conversion takes place within a certain amount of time, or something happens or doesn't happen. Usually it's got to be a good thing for this to happen. If something good happens, the company is doing well, then these contingent shares, which is part of some agreement, will be issued, and these shares will only affect the denominator of the diluted earnings per share calculation, so they do not get involved in that order of entry business. And that is earnings per share.